Picture this. You wake up, check your portfolio, everything's green. An hour later, you've lost more money than most people make in a year. Welcome to January 29th, 2026, the day the precious metals market went absolutely nuclear. In just 60 minutes, we witnessed what I'm calling the fastest wealth destruction event in modern commodity history. Silver? It nosedived from $121 straight down to $108. That's $13 per ounce. Poof, vanished. Gold? Plummeted from $500 to $600 all the way to $500. A brutal $500 drop in the time it takes to grab lunch. Do the math with me. If you were sitting on $100,000 worth of silver this morning, by lunchtime, you were staring at $89,000. That's not a typo. $11,000 evaporated while you were probably checking your email. Right now, across every trading floor, every home office, every mobile trading app, there are people watching their life savings bleed out in real time. Forced liquidations, creating more forced liquidations. It's a domino effect of financial destruction. The talking heads on CNBC, they'll call it market correction. Healthy volatility. Normal profit taking. Complete garbage. This wasn't normal. This wasn't healthy. This was surgical, calculated. And if you don't understand the mechanics behind what just happened, you're going to be on the wrong side of the next one. But here's the twist nobody saw coming. I watched this identical setup play out just weeks ago. End of December 2025. Same violence, same panic, same carnage. Want to know what happened after that December bloodbath? January went parabolic. Gold rocketed 30% higher. Silver exploded 65% in a single month. Historic, unprecedented, massive. So here's the million-dollar question. Is today's crash the finale? Or are we looking at the setup for an even bigger explosion? The next 20 minutes will give you the complete anatomy of this crash. I'll show you the invisible driver that controls precious metals that 95% of traders never even look at. And I'm putting a specific price target with a specific deadline on the record. Miss this, and you'll miss the blueprint for navigating the chaos that's coming. Let's go. If you're new here, welcome to the only breakdown that doesn't sugarcoat reality. Hit subscribe because what I am about to reveal could be the difference between surviving and thriving in this market. Here's your roadmap. Part 1, the minute-by-minute anatomy of destruction, how 6 trillion got vaporized faster than you can say margin call. Part 2, the secret metric. I'll reveal the single indicator that telegraphed this crash days in advance, yet almost no retail traders track it. Part 3, the trinity of destruction. 3 converging forces that created the perfect storm and why understanding each one is non-negotiable. Part 4, the road ahead. I'm giving you 3 distinct scenarios with precise probability assessments, plus my bold call for mid-February. Part 5, your action plan. Specific strategies for physical holders, leverage traders, and cash-heavy investors waiting for their entry. No fluff. No excuses, just the raw intel you need. Let's dissect what actually went down. Here's how the massacre unfolded, tick by tick. 10:30 a.m. Est. Gold sitting pretty at $5,600. Silver comfortable at $121. Trading volume normal. Buy. Market sentiment calm, maybe too calm. 10:45 a.m. Warning signs flash. Gold slips to $5,150. Silver ticks down to $119. Volume explodes out of nowhere. Large sell orders hitting the tape. Someone knows something. 11:02 a.m. The dam breaks. Gold crashes through $5,400. Silver hemorrhaging to $115. Automated liquidations start firing. Long positions with leverage getting obliterated. The cascade begins 11:15 a.m. Full market panic. Gold collapses to $5,200. Silver in free fall at $110. Stop loss orders triggering in waves. Each liquidation spawns 3 more. Fear goes exponential. 11:30 a.m. The crater. Gold bottoms at $5,100. Silver hits $108. $500 off gold, $13 off silver. 60 minutes. This wasn't a correction. This was a controlled demolition. Here's what separates amateurs from professionals. Understanding that crashes aren't just about price falling. They're about mechanical chain reactions. Think about it. When a leveraged trader gets a margin call, it's not a suggestion. The system automatically liquidates their position. No questions asked, no mercy. That forced selling hammers price lower, which triggers the next wave of margin calls, which creates more forced selling, which drives price even further down. It's a self-reinforcing death loop. Automatic liquidations, breeding more automatic liquidations. 5x leverage, you got wiped. 10x leverage, you lost your entire account, plus you now owe money to your broker. This is exactly why leverage in volatile assets is like playing Russian roulette with 5 bullets. But here's what everyone's demanding to know. What was the trigger? Because precious metals don't spontaneously combust. Something, somewhere, lit the fuse. And that fuse has been sitting in plain sight, screaming warnings to anyone who knew where to look. I'm about to give you the single most valuable lesson in precious metals trading. Most retail traders are glued to gold charts. They're hypnotized by silver charts. They watch candlesticks all day like it's Netflix. They're staring at the wrong screen. The real action? It's happening on the DXY chart, the US dollar index. If that term means nothing to you, pay close attention. What I'm about to explain will clarify 90% of the price moves that have confused you for years. So what exactly is the DXY? It's a real-time scorecard measuring US dollar strength against 6 major global currencies. Euro, largest weight, Japanese yen, British pound, Canadian dollar, Swedish krona, Swiss franc. DXY climbing, dollar is strengthening versus these currencies. DXY dropping, dollar is weakening versus these currencies. Now here's the game changer that most investors never grasp. Gold and silver are in a permanent inverse relationship with the dollar. They're negatively correlated. Not sometimes, not when it's convenient, nearly always. Visualize a teeter-totter at a park. US dollar on one end, gold and silver on the other end. Dollar end goes up, precious metals end goes down. Dollar end goes down, precious metals end goes up. Both ends cannot rise simultaneously. Physics doesn't allow it. The mechanism behind this? Gold and silver are denominated in dollars. When the dollar appreciates, each dollar buys more gold, so the nominal price drops. When the dollar depreciates, each dollar buys less gold, so the nominal price rises. This isn't rocket science. This is trading 101. Yet 90% of retail participants completely ignore this relationship. They buy precious metals without a single glance at dollar strength. Then they're shocked when their positions get stopped out, confused when their timing is always wrong, convinced the game is rigged. The game isn't rigged, they're just watching the wrong game. Institutional traders? They monitor the DXY obsessively. They spot dollar strength building and they're dumping metals while retail is still loading up. By the time your gold chart shows red, the smart money exited 10 minutes ago. You became their liquidity. Today, the DXY absolutely exploded higher. Dollar strength surged. The dollar end of the teeter-totter shot up. Gold and silver absolutely demolished. The other end crashed down. If you remember nothing else from this video, remember this. The DXY is your early warning system. Dollar strength, stars, metals, pain. Dollar weakness, metals gain. Now let me break down the 3 specific catalysts that launched the dollar into orbit today. Understanding what drove dollar strength helps you anticipate the next move. Miss even one of these and you're trading blind. Catalyst number 1. Federal Reserve turns aggressive. The Fed is currently in what we call hawk mode. Let me decode this. Hawk mode shows Fed wants to maintain high rates or potentially raise them even higher. Dove mode, source Fed wants to cut rates and ease policy. Current stance? Maximum hawk. Here's why this matters for your portfolio. Elevated interest rates make dollar assets irresistible to global capital. Higher rates mean superior returns on US treasuries. Better yields on dollar-based investments. What's the global investor response? They acquire dollars. They liquidate euros, yen, pounds, converting everything to dollars to capture those yields. Increased dollar demand. DXY surges. When DXY surges, precious metals get crushed. The Fed shocked markets this year. Everyone anticipated aggressive rate cuts. Instead, they barely moved. They're paranoid about inflation resurgence. Fed chair. Jerome Powell was explicit last week. He used the phrase, higher for longer. Markets heard, dollar rallied, metals collapsed. That's catalyst number 1. Catalyst number 2, China's industrial deceleration, silver's nightmare. If you're holding silver, this section is critical. China's industrial machine is sputtering. Recent data reveals manufacturing sector contracting, factory production declining, economic growth losing momentum. Why does this specifically target silver? Because silver has a split personality. It's both precious and industrial. Over 50% of annual silver consumption comes from industrial applications. Solar panels. Silver is essential for every single panel. Consumer electronics. Every smartphone, every laptop contains silver. Electric vehicles. EVs require significantly more silver than traditional cars. Semiconductor manufacturing. AI infrastructure, data centers, all silver dependent. And the epicenter of this manufacturing? China. When China slows, traders immediately fear collapsing silver demand, reduced solar panel production, declining electronics manufacturing, less silver needed globally. Fear converts to selling in milliseconds. Silver, with its higher volatility and stronger industrial ties, takes a disproportionate beating compared to gold. This explains why silver crashed 11% versus gold's 9% drop. China's troubles hit silver harder because silver is industrial ammunition. That's catalyst number 2. Catalyst number 3, government shutdown looming, the panic button. January 31st is 48 hours away. Congress hasn't passed a funding bill. Government shutdown incoming. Shutdowns aren't new. They typically resolve. But markets despise uncertainty. Uncertainty triggers risk-off mode. Traders close positions, lock in gains, run for the exits, shoot first, ask questions later. After this month's monster rally, gold plus 30%, silver plus 65%, traders were sitting on enormous profits. Many were actively hunting for a reason to capture those gains. Bank some wins, shutdown fears, provided the perfect excuse, not the sole reason, but the psychological trigger. That's catalyst number 3. 3 catalysts converging simultaneously. 1, Fed aggressive. 2, China weakening. 3, political chaos brewing. Any single catalyst, minor turbulence, all 3 simultaneous. Outcome, $6 trillion incinerated in 1 hour. Now, let me reveal something crucial about the gold-silver relationship that most traders misunderstand. Most people assume gold and silver move in lockstep with identical magnitude. That assumption will destroy your portfolio. Yes, they move in the same direction, but absolutely not with the same magnitude. Silver is gold on rocket fuel. Gold moves 5%. Silver typically moves 10, 12%. Same direction, double or triple the violence. Gold rallies 10%. Silver explodes 20%. Gold crashes 8%. Silver craters 16, 20%. Today's evidence, gold 9% from $5,600 to $5,100. Silver 11% from 121 to 108. This isn't random. This is the silver amplification effect in action. Gold sets direction. Silver follows. But silver follows with turbocharged intensity. This explains January's performance. Silver's 65% gain versus gold's 30% gain. And it explains today's carnage. Silver's heavier losses. If you're trading silver, this is non-negotiable knowledge. Silver accelerates wealth creation, but it also accelerates wealth destruction. The weapon cuts both directions. Here's something fascinating. Rewind to Monday. A few days ago, we saw another crash. That crash had completely different DNA. Monday, silver crashed 14%, while gold barely dropped 2%. Why? Monday's crash was silver isolated, driven purely by industrial demand fears, China-specific news, silver-targeted selling. Today's crash? Fundamentally different. Today, both metals crashed in unison. Gold 9%, silver 11%. When both crash together with similar magnitude, it signals a different root cause. Not metal-specific, it's macro-driven. Today's macro driver? The US dollar. DXY surged, both metals imploded. This distinction matters because it tells you what to monitor. To anticipate the next crash, track the dollar. Not just gold, not just silver. The dollar dominates everything. Now let me show you why today's crash might actually be setting up something massive. I've witnessed this exact sequence before, not years ago, not last quarter, 3 weeks ago. December 2025, final 2 trading days. December 30th and 31st, identical scenario, violent crash from nowhere. Mass panic selling, cascading liquidations, red candles stacked like dominoes, weak hands capitulating. Sentiment was apocalyptic, social media flooded with despair. Market obituaries everywhere. Bull market over. Gold and silver dead. The top is in. Maximum fear. Complete despair. Then January detonated. January 2026. This month. The month currently ending. Gold, plunging 30% in 30 days. Marine silver, plus 165% in 30 days. All-time highs. Obliterated. Biggest monthly surge in 4 decades. Every person who panic sold in December, who capitulated at the bottom from fear, who believed the doom prophets? They watched the rocket leave without them on board. They sold low. They missed the entire explosive move. Fast forward to today, January 29th, 2 days before month end. Violent crash. Mass panic selling. Cascading liquidations. Identical pattern, identical timing, identical fear. The critical question, will February replay January's explosion? Let me show you why I believe history is about to repeat. First, recognize what hasn't changed. Today's crash was driven by dollar strength spike, Fed policy fears, short-term panic, weak hands shaking out. But the structural fundamentals, the bigger macro picture, zero change. While panic consumed retail traders, Tether continued buying 1-2 tons of gold weekly like clockwork. BRICS nations kept stacking, China, Russia, India accumulating on dips. De-dollarization trend accelerating globally. Silver supply deficit persisting. 5th consecutive year. What changed? Only sentiment. That's it. Weak hands panicked and sold. Strong hands accumulated. Sentiment is fickle. It flipped negative in 60 minutes. It can flip positive just as fast. Now here are 3 distinct scenarios with probability weights. Scenario 1, continuation of bull market, 65% probability. Today's crash mirrors. December, perfectly. Weak hands flushed before next rally leg. February, open strong. March brings new all-time highs. Silver targets $150 and gold targets $6,000. Scenario 2, extended correction phase, 25% probability. Fed intensifies hawkish stance. Dollar strength persists. China data deteriorates further. Additional downside coming. Gold retests $4,800 support. Silver retests $90 support. Scenario 3, sideways consolidation, 10% probability. No breakout. No major crash. Frustrating, choppy, range-bound trading for weeks. Traders lose interest. Retail capitulates from boredom. Then, explosive move catches everyone off guard. My specific on-record prediction, silver reclaims $120 before February 15th. Not by spring, not by Q2. By February 15th, that's 17 calendar days from now. My reasoning? 1. Today's $108 crash was violent but small versus the January rally's magnitude. 2. December pattern strongly suggests rapid bounce. 3. Structural fundamentals remain intact. 4. Shutdown resolution by Feb 15th removes uncertainty catalyst. Target $120. Deadline February 15th on permanent record. Screenshot this. Hold me accountable. Now let me give you your specific action plan. If you own physical gold and silver, take 0 action. Physical precious metals aren't trading vehicles. They're insurance policies. Long-term wealth storage, generational wealth preservation. You don't liquidate insurance because markets had a bad day. You don't empty your savings account because of volatility. Physical metals function identically. No realized loss until you actually sell. Until then, it's just screen numbers. If you acquired physical silver at $100, you still possess that silver. Today's crash didn't repossess it. Ignore short-term noise. Check back in 6 months. Fundamentals remain unchanged. If you're using leverage, today delivered your wake-up call. Leverage in volatile commodities is financial suicide. Cascading liquidations should terrify you. Stop losses fail when price gaps violently. You get liquidated far worse than your stop level. Dramatically reduce leverage or eliminate it completely. If you're holding cash, waiting, this could be your window. Optimal buying occurs during maximum blood in the streets, when fear dominates, when panic rules. That's when institutional money accumulates. That's when wealth transfers from the fearful to the disciplined. Only deploy capital you can hold through continued volatility. Scale into positions. Never go all in at once. Buy some now. If it drops further, buy more. If you bought the absolute top, I won't sugarcoat this. Watching 11% in 1 hour is brutal. You have 2 options. Option 1, panic, sell at the bottom. Crystallize your loss. Make it permanent. Option 2, endure the volatility and wait for recovery. Accept poor timing, but recognize poor timing, poor investment thesis. If fundamentals remain solid, if long-term thesis remains intact, your only error was entry timing. Timing errors get corrected by time. History rewards patience. But you must emotionally survive the drawdown period. Can you handle that? Only you know your psychology. Here's the ultimate truth. Markets exist to redistribute wealth, from the impatient to the patient, from the emotional to the disciplined, from those who panic to those who prepare. Today, $6 trillion changed ownership in 60 minutes. Somebody lost that capital. Somebody else captured it. Which side were you on? If you panic sold during the crash, you transferred your wealth to somebody who planned for this exact scenario. Somebody who understood the game mechanics. If you held firm, you still have opportunities. The game continues. December crashed brutally. January exploded. January's crashing now. February approaches. The pattern sits in plain view. Will it repeat? Share your analysis in the comments. I'm releasing a follow-up video February 1st, dissecting what actually happened. If this breakdown gave you clarity on today's chaos, smash the like button. Forward this to anyone currently panicking. Subscribe now. I don't trade in hype. I don't peddle hopium. I deliver unfiltered analysis so you can make informed decisions. Final thought. $6 trillion vaporized in 60 minutes. That already happened. No changing it. What you can control is your next move. Will you panic? Will you freeze? Or will you learn, adapt, and prepare? Markets exclusively reward those who understand their mechanics. Stay disciplined. Stay educated. And critically, next time, position yourself on the winning side of the wealth transfer. See you in the next breakdown.